This presentation is for Accounting 221, Accounting Principles 1, Chapter 5, Merchandising Operations. These are the first three objectives for Chapter 5, to describe merchandising operations and the two types of merchandise inventory systems, and to account for the purchase and sales of merchandise inventory using a perpetual inventory system. These are the next three objectives for Chapter 5, to adjust and close the accounts of a merchandising business, to prepare a merchandiser's financial statements, and to use the gross profit percentage to evaluate business performance. The last two objectives for Chapter 5 are to account for multiple performance obligations using a perpetual inventory system, and to account for the purchase and sale of merchandise using a periodic inventory system. In the first section, we will describe merchandising operations and the two types of merchandise inventory systems. A merchandiser is a business that sells merchandise or goods to customers. The merchandise that a business sells to customers is called merchandise inventory. A wholesaler is a type of merchandiser that buys goods from manufacturers and then sells them to retailers. A retailer is a type of merchandiser that buys merchandise either from a manufacturer or a wholesaler and then sells those goods to consumers. The operating cycle has three main steps. A company purchases inventory from a vendor, the company sells the inventory to a customer, and the company collects cash from customers. A vendor is an individual or a business from whom the company purchases goods. The operating cycle of a merchandiser is presented in Exhibit 5.1. A merchandiser purchases inventory and then sells the inventory to customers in exchange for cash. Because the operating cycle of a merchandiser is different from that of a service company, the financial statements differ. On the income statement, a merchandising company reports revenues using an account called sales revenue rather than the account service revenue. A merchandiser also reports the cost of merchandise inventory that has been sold to customers, or cost of goods sold. The cost of goods sold is the cost of merchandise inventory that the business has sold to customers. Because cost of goods sold is usually a merchandiser's main expense, an intermediary calculation, gross profit, is determined before net income is calculated. Gross profit is the excess of net sales revenue over cost of goods sold. Operating expenses are expenses other than cost of goods sold that are incurred in the entity's major ongoing operations. The financial statements of merchandising companies also look somewhat different from what we have seen so far. The most notable difference is that the income statement for a merchandising company includes line items for cost of goods sold and gross profit. The balance sheet shows a new asset account called merchandise inventory. Merchandise inventory is a current asset since it is expected to be sold within the operating cycle. A periodic inventory system is an inventory system that requires businesses to obtain a physical count of inventory to determine quantities on hand. The periodic inventory system is most appropriate for inexpensive inventory that is sold by small shops that do not have optical scan or point of sale capability. A perpetual inventory system is an inventory system that keeps a running, computerized record of merchandise inventory. In a perpetual inventory system, the cash register at the store is a computer terminal that records sales and updates inventory records. Barcodes are scanned by a laser. The barcoding is linked to merchandise inventory and cost data that are used to keep track of each unique inventory item. However, note that even in a perpetual inventory system, the business must count inventory at least once a year. The physical count captures inventory transactions that are not recorded by the electronic system, such as misplaced, stolen, or damaged inventory. The count establishes the correct amount of ending inventory for the financial statements and also serves as a check on the perpetual records. In the second section, we will account for the purchase of merchandise inventory using a perpetual inventory system. The cycle of a merchandiser begins with the purchase of merchandise inventory. An invoice is the seller's request for payment from the purchaser. Invoices are also called bills. Sellers have sales invoices. Purchasers have purchase invoices. Look at the invoice from Southwest Electronics Direct in Exhibit 5.3. It shows that Smart Touch Learning acquired $35,000 of inventory on June 1, 2019. Ignoring the purchase terms, the merchandise inventory account is an asset and is increased with a debit. On June 3rd, Smart Touch Learning will record the purchase by debiting merchandise inventory. If the transaction is on account, then Smart Touch Learning will record a credit to accounts payable for $35,000. At this point, we have not accounted for the purchase discount terms. If Smart Touch Learning takes advantage of the discount, we will adjust the accounts payable account appropriately at that time. The purchase discount is from the purchaser's perspective. A purchase discount is a discount that businesses offer to purchasers as an incentive for early payment. The payment terms of the purchase or sale are stated on the invoice. Credit terms of 3/15 net 30 days means that Smart Touch Learning can deduct 3% from the total bill, excluding freight charges, if any, if the company pays within 15 days of the invoice date. Otherwise, the full amount, net, is due in 30 days. These credit terms can also be expressed as 3/15 N30. Terms of N30 mean that no discount is offered and payment is due 30 days after the invoice date. Most credit terms express the discount time period, and the final due date. Occasionally, the credit terms are expressed as EOM, which means payment is due at the end of the current month. Recall that we earlier recognized the vendor offered Smart Touch Learning sales terms of 3/15 net 30 days. According to the sales terms, Smart Touch Learning will receive a 3% discount if it pays within 15 days of the invoice date, June 1st, 2019. Notice that the balance in the merchandise inventory account, $33,950, is exactly what was paid for the merchandise inventory on June 15, 2019. Also notice that the accounts payable account shows that the invoice was paid in full with no remaining balance. Recall that we earlier recognized the vendor offered Smart Touch Learning sales terms of 3/15 net 30 days. If Smart Touch Learning must pay the full $35,000 if payment is made on June 24th after the discount period ends. Purchase returns are a situation in which sellers allow purchasers to return merchandise that is defective, damaged, or otherwise unsuitable. A purchase allowance is an amount granted to the purchaser as an incentive to keep goods that are not as ordered. On June 4, Smart Touch Learning returns $7,000 of the inventory to the vendor. This has the effect of reducing this outstanding account payable from $35,000 to $28,000. The exact same entry is made for a purchase allowance granted to the buyer from the seller or vendor. The only difference between a purchase return and a purchase allowance is that in the case of the allowance, Smart Touch Learning keeps the inventory. Occasionally, a business will return merchandise inventory or receive an allowance before payment has been made. In this scenario, if the payment of the invoice is made within the discount period, the discount should be calculated net of the return or allowance. Suppose that on June 10th, Smart Touch Learning purchased 15 tablets from Southwest Electronics Direct on account with credit terms of 3/15 net 30 at a cost of $5,250. 5 days later, Smart Touch Learning returned 5 tablets to the vendor because of damages and received a purchase return of $1,750. When Smart Touch Learning makes payment on June 20th within the discount period, it will calculate the discount on the amount due less the return of $3,500, which is $5,250 minus $1,750. Smart Touch Learning's discount will be $105, which is $3,500 times 3%. Either the buyer or the seller must pay the transportation cost of shipping merchandise inventory. The purchase agreement specifies FOB, which means free on board, terms to determine when title to the goods transfers to the purchaser and who pays the freight. FOB shipping point is a situation in which the buyer takes ownership or title of the goods after the goods leave the seller's place of business, the shipping point, and the buyer typically pays the freight. FOB destination is a situation in which the buyer takes ownership or title of the goods at the delivery destination point and the seller typically pays the freight. Freight in is the transportation cost to ship goods into the purchaser's warehouse. Thus, it is freight on purchased goods. Freight out is the transportation cost to ship goods out of the seller's warehouse and to the customer. Thus, it is freight on goods sold to a customer. Either the buyer or the seller must pay the transportation cost of shipping merchandise inventory. The purchase agreement specifies FOB terms to determine when title to the goods transfers to the purchaser and who pays the freight. FOB shipping point is a situation in which the buyer takes ownership or title of the goods after the goods leave the seller's place of business, the shipping point, and the buyer typically pays the freight. FOB destination is a situation in which the buyer takes ownership or title of the goods at the delivery destination point and the seller typically pays the freight. Assume Smart Touch Learning pays a $60 freight charge on June 3rd for a purchase with FOB shipping point. Smart Touch Learning should record a debit to merchandise inventory and a credit to cash. Discounts are computed only on the merchandise purchased from the seller. Discounts are not computed on the transportation cost because there is no discount on freight. Under FOB shipping point, the seller sometimes prepays the transportation cost as a convenience and lists this cost on the invoice. Assume, for example, Smart Touch Learning makes a $5,000 purchase of goods coupled with a related freight charge of $400 on June 20th on account with terms of 3/15 net 30. The terms of shipment are FOB shipping point. The seller prepays the freight charge. If Smart Touch Learning pays within the discount period, the discount will be computed only on the $5,000 merchandise cost, not on the total invoice of $5,400. The $400 freight is not eligible for the discount, so the 3% discount would be $150, $5,000 times 3%. The net cost of merchandise inventory purchased includes the purchase cost of inventory, less purchase returns and allowances, less purchase discounts, plus freight in. Knowing the net cost of inventory allows a business to determine the actual cost of the merchandise purchased. The calculation of net cost of inventory purchased is determined as follows. Purchase cost of inventory minus purchase returns and allowances minus purchase discounts plus freight in is equal to the net cost of inventory purchased. During the year, Smart Touch Learning buys $281,750 of inventory, returns $61,250 of the goods, and takes a $4,410 early payment discount. The company also pays $14,700 of freight in. Net cost equals $230,790. In the third section, we will learn how to account for the sale of merchandise inventory using a perpetual inventory system. After a company buys merchandise inventory, the next step is to sell the goods. At the time of sale, 2 entries must be recorded in the perpetual inventory system. One entry records the sales revenue and the cash or accounts receivable at the time of sale. The second entry records cost of goods sold, debit the expense, and reduces the merchandise inventory, credit the asset. Sales revenue is the amount that a merchandiser earns from selling its inventory. A sales invoice is an agreement between buyer and seller. To the seller, a sales invoice is a bill that shows what amount the customer must pay. To record the sale by Smart Touch Learning, two journal entries must be recorded. The first journal entry records the cash sale of $1,000 by debiting cash and crediting sales revenue. A second journal entry must also be made to record the expense and decrease the merchandise inventory balance. Suppose these goods sold by Smart Touch Learning cost $700. The second journal entry would transfer the $700 from the merchandise inventory account to the cost of goods sold account. The cost of goods sold account keeps a current balance throughout the period in a perpetual inventory system of the cost of merchandise inventory sold. In this example, cost of goods sold is $700, the cost to Smart Touch Learning, rather than $1,000, the sales or retail price of the goods. Cost of goods sold is always based on the company's cost, not the retail price. Many sales are made on account, on credit, instead of with cash or a credit card. Many sellers offer customers a discount for early payment. Sales discounts are a reduction in the amount of revenue earned on sales for early payment. The new revenue recognition standards require sales to be recorded at the net amount or the amount of the sale less any sales discounts. Assume on June 21st, Smart Touch Learning sold 10 tablets for $500 each on account with terms of 210 net 30. The goods cost $3,500. In this case, Smart Touch Learning will record the sale at the net amount of $4,900, the $5,000 less the 2% discount of $100, $5,000 times 2%. Smart Touch Learning credited the accounts receivable for the net amount of the invoice. By doing this, Smart Touch Learning has shown that the invoice was paid in full with no remaining balance. If for some reason the customer does not pay within the discount period, the customer will no longer receive the $100 discount and the customer must pay the full $5,000 amount. Smart Touch Learning would record the discount lost using the account sales discounts forfeited. The account sales discount forfeited increases other income and expenses on the income statement. Notice that in either scenario, if the customer paid within the discount period or outside of the discount period, Smart Touch Learning credited the accounts receivable for the net amount of the invoice. By doing this, Smart Touch Learning has shown that the invoice was paid in full with no remaining balance. The return of goods by a customer or the granting of an allowance is called sales returns and allowances. Under the new revenue recognition standard, companies should only record sales revenue in the amount they expect to eventually realize. Companies must decrease sales revenue by an estimated amount of sales returns. Historical data can be used for this estimate. Smart Touch Learning has sales of $1 million for the period ending December 31st, 2019. The cost of goods sold related to those sales was $600,000. Smart Touch Learning estimates that approximately 4% of the merchandise sold will be returned, or $40,000 of sales revenue and $24,000 of merchandise inventory. Smart Touch Learning will need to record two adjusting entries on December 31 to account for the estimated returns. The first adjusting entry involves a debit to sales revenue that reduces sales for the year by the expected amount of the returns, thereby recording sales revenue at the net amount the company expects to eventually collect. The refunds payable account is a liability account and is reported on the balance sheet. In the second adjusting entry, Smart Touch Learning debits an asset account, estimated returns inventory, that represents the cost of the inventory the company believes it will receive in returns. The corresponding credit to cost of goods sold decreases the expense. When a customer actually returns the inventory, the company will need to record the refund of cash to the customer or credit of accounts receivable, and also the return of merchandise inventory. For example, assume that on January 20th, 2020, a customer returned merchandise purchased with cash with a sales price of $2,000. The cost of the goods was $800. In recording the entry, Smart Touch Learning decreases the payable associated with the amount of estimated refunds. In addition, the merchandise inventory account has increased because the company received the returned inventory. To offset this, the estimated returns inventory account decreases. In situations of a sales allowance, a customer requests a refund of some portion owed, but the customer does not return the inventory. When a seller grants a sales allowance, the company issues a credit memo indicating that the company will reduce the customer's accounts receivable or issue a cash refund. The company also reduces the estimated refunds payable. Because there is no return of goods, the company does not need to record a second entry to adjust the merchandise inventory account. Suppose that on January 28, 2020, Smart Touch Learning grants a $100 sales allowance for goods damaged in transit. The goods were sold on account and remain unpaid. Remember that a freight out expense is one in which the seller pays freight charges to ship goods to customers. Freight out is a delivery expense to the seller. Delivery expense is an operating expense and is debited to the delivery expense account. For example, Smart Touch Learning paid $30 to ship goods to a customer on June 21, 2019. In the fourth section, we will learn how to adjust and close the accounts of a merchandising business. A merchandiser adjusts and closes accounts the same way a service entity does. If a worksheet is used, the unadjusted trial balance is entered and the worksheet is completed to determine net income or net loss. In addition to adjusting for estimated sales returns as illustrated earlier in the chapter, merchandisers must also account for inventory shrinkage. The merchandise inventory account should stay current at all times in a perpetual inventory system. However, the actual amount of inventory on hand may differ from what the books show. The difference can occur because of theft, damage, and errors and is reported as inventory shrinkage. For this reason, businesses take a physical count of inventory at least once a year. The most common time to count inventory is at the end of the fiscal year. The business then adjusts the merchandise inventory account based on the physical count. Smart Touch Learning must record an adjusting entry to account for this lost inventory. Smart Touch Learning's merchandise inventory account shows an unadjusted balance of $31,530. With no shrinkage due to theft or error, the business should have inventory costing $31,530. But on December 31, Smart Touch Learning counts the inventory on hand and the total cost comes to only $30,000. Cost of goods sold should be debited and merchandise inventory should be credited for the amount of shrinkage, $1,530. This entry brings merchandise inventory to its current balance and increases cost of goods sold for the cost of the lost inventory. The four-step closing process for a merchandising company follows. Step 1, make the revenue accounts equal zero via the income summary account. Step 2, make expense accounts equal zero via the income summary account. Step 3, make the income summary account equal zero via the retained earnings account. This closing entry transfers net income or net loss to retained earnings. Step 4, make the dividends account equal zero via the retained earnings account. Exhibit 5.6 presents Smart Touch Learning's adjusted trial balance and closing entries for the year. New accounts are highlighted in blue. Exhibit 5.6, as continued on this slide, presents Smart Touch Learning's adjusted trial balance and closing entries for the year. New accounts are highlighted in blue. In the fifth section, we learn how to prepare a merchandiser's financial statements. The income statement can appear in two formats. the single-step format, and the multi-step format. The single-step income statement is the income statement format that groups all revenues together and all expenses together without calculating subtotals. A single-step income statement works well for service entities because they have no gross profit to report. A multi-step income statement is an income statement format that contains subtotals to highlight significant relationships. In addition to net income, it reports gross profit and operating income. A single-step income statement does not provide subtotals. Many companies use this format. The single-step format clearly distinguishes revenues from expenses and works well for service entities because they have no gross profit to report. Both merchandisers and service companies report operating expenses in two categories. Selling expenses are expenses related to marketing and selling the company's goods and services. These include sales salaries, sales commissions, advertising, depreciation on store buildings and equipment, store rent, utilities on store buildings, property taxes on store buildings, and delivery expense. Administrative expenses include expenses not related to marketing the company's goods and services. These include office expenses such as the salaries of the executives and office employees, depreciation on office buildings and equipment, rent other than on stores, for example, rent on the administrative office, utilities other than on stores, for example, utilities on the administrative office, and property taxes on the administrative office building. Gross profit minus operating expenses equals operating income, also called income from operations. Operating income measures the results of the entity's major ongoing activities or normal operations. After operating income, sometimes called income from operations, the next section of the income statement is other income and expenses. This category reports revenues and expenses that fall outside the business's main day-to-day regular operations. Examples include interest revenue, sales discounts forfeited, interest expense, and gains and losses on the sale of plant assets. These examples have nothing to do with the business's normal operations. As a result, they are classified as other items. Lastly, corporations are required to pay income tax. Therefore, the last section of the income statement is the income tax expense section. This section reports the federal and state income taxes that are incurred by the corporation. The calculation of income tax expense is complicated and will be covered in later accounting courses and is only presented here for informational purposes. A multi-step income statement is different than a single-step income statement because it lists several important subtotals. In addition to net income, the bottom line, it also reports subtotals for gross profit, operating income, also called income from operations, and income before income tax expense. The income statement begins by calculating gross profit. Gross profit is the markup on the merchandise inventory and is calculated as net sales revenue minus cost of goods sold. Net sales revenue is sales revenue less discounts and estimated returns and allowances. Gross profit, along with net income, is a measure of a business's success. A sufficiently high gross profit is vital to a merchandiser. Next, the operating expenses, those expenses other than cost of goods sold, are listed. A merchandiser's statement of retained earnings looks exactly like that of a service business. The balance sheet will also look the same as for a service business, except merchandisers have an additional current asset, merchandise inventory. Service businesses do not have merchandise inventory. In the sixth section, we will learn how to use the gross profit percentage to evaluate business performance. The gross profit percentage is one of the most carefully watched measures of profitability. It reflects a business's ability to earn a profit on its merchandise inventory. A small increase in the gross profit percentage from last year to this year may signal an important rise in income. Conversely, a small decrease from last year to this year may signal trouble. In general, a high gross profit percentage is desired. This slide shows the gross profit percentages for Kohl's Corporation for fiscal years 2014 and 2015. The gross profit percentage decreased slightly from fiscal year 2014 to 2015, signifying that the percentage of gross profit on sales is decreasing. However, when compared with the industry average for gross profit percentage, 35%, Kohl's is slightly higher than average. Kohl's should monitor the amount of profit it is earning on its merchandise inventory and take action if the percentage continues to drop. In the 7th section, we will learn how to account for multiple performance obligations using a perpetual inventory system. Companies are required to identify the performance obligations associated with each contract. A performance obligation is a contractual promise with a customer to transfer a distinct good or service. When contracts involve multiple performance obligations, the company is required to allocate the transaction price to each performance obligation separately. On November 1st, Smart Touch Learning sells one tablet, cost of $350, along with a 2-year service contract to a customer for $620. The customer pays cash at the time of the sale. The $620 sales price must be allocated among each performance obligation. Smart Touch Learning allocates the sales price of $620 as follows: $500 for the tablet and $120 for the 2-year service contract. In recording the transaction, Smart Touch Learning should only recognize revenue when or as it satisfies each performance obligation. The $500 associated with the tablet would be recognized as sales revenue because the tablet has been delivered to the customer. The $120 for the 2-year service contract would be recorded as unearned revenue because the company has not satisfied the obligation of servicing or fulfilling the service contract. As Smart Touch Learning satisfies the service contract, the company would recognize the revenue. For example, at December 31, Smart Touch Learning has provided 2 months of service for the tablet. Smart Touch Learning would record $10 of service revenue, $120 divided by 24 months times 2 months. In the 8th section, we learn how to account for the purchase and sale of merchandise using a periodic inventory system. In a periodic inventory system, purchases, purchase discounts, purchase returns and allowances, and freight in cost are recorded in separate accounts during the year, and then the merchandise inventory account is updated during the closing process. In a periodic system of accounting for inventory, each purchase of inventory is not tracked directly in the accounting system. Rather, purchases are recorded in a purchases account. Information related to sales of inventory during the period is accumulated and accounted for at the end of the period in one large sum. In this invoice example, Smart Touch Learning is being billed for the purchase of 100 touchscreen tablet computers at an amount of $350 each. The invoice has sales terms stated as 315 net 30 days. In a periodic system, Smart Touch Learning will still credit accounts payable. However, the debit will go to an account called Purchases. This account will be used to accumulate all the purchase information for the period. At the end of the period, the Purchases account will be closed via the income summary. Suppose that prior to payment on June 4, Smart Touch Learning returned 20 tablets to the vendor costing $7,000. In the periodic inventory system, instead of recording the return to merchandise inventory, a separate account, purchase returns and allowances is used. Both purchase discounts and purchase returns and allowances are contra expense accounts. They are contra accounts to the purchases account. To determine the net amount of purchases, you subtract the purchase returns and allowance and purchase discounts from the gross amount of purchases recorded for the period. Under the periodic inventory system, freight in is debited to a separate freight in account, an adjunct expense account, as opposed to debiting the merchandise inventory account. Recording sales of merchandise inventory is streamlined in the periodic inventory system. With no running record of merchandise inventory to maintain, There is no need to record an entry to merchandise inventory and cost of goods sold. Instead, a sale of inventory involves recording only the sales revenue portion. Accounting for sales discounts and sales returns and allowances is the same as in a perpetual inventory system, except there are no entries for merchandise inventory. The periodic inventory system requires an additional calculation, the cost of goods sold. At the end of each period, the company combines a number of accounts to compute cost of goods sold for the period, and this calculation is shown on the income statement. Cost of goods sold equals $540,000 for Smart Touch Learning. There is no need to record an adjustment for inventory shrinkage since there is no difference between the accounting records and the physical count of inventory on hand. The process of recording the ending merchandise inventory is completed through the closing entry process. The adjusted trial balance shows the accounts associated with the periodic inventory system. The temporary accounts associated with the periodic inventory system are closed via the income summary. There is a 4-step closing process under the periodic inventory system. Step 1, using the periodic inventory system, sales revenue and sales discounts forfeited or closed with a debit via the income summary account. All other temporary accounts with a credit balance are also closed. The ending merchandise inventory and estimated returns inventory are recorded as debits. There is, in Step 2, expense accounts and other temporary accounts with debit balances are closed via the income summary account. The beginning merchandise inventory, purchases, and freight in are also closed via the income summary account. The key difference in the closing process under the periodic inventory system is how merchandise inventory is handled. In the periodic inventory system, the ending merchandise inventory balance must be recorded as a debit during closing, and the beginning merchandise inventory balance must be recorded as a credit during closing. The additional purchases and related contra and adjunct accounts must also be closed. Step 3 and 4. These steps, closing the income summary and dividends accounts, are the same under both the perpetual and periodic methods. This is the conclusion of the presentation for Chapter